Welcome and thanks for joining us here on Berman's Call. Here to take your questions today on stocks and ETFs. Here's how to reach us. You can call us toll free 1-855-326-6266. You can email your questions in as well. Berman's Call at BNN Bloomberg.ca. There is the information. Larry, let's talk about what's been going on. I was looking at Black Friday numbers. Salesforce is saying the online numbers were pretty good. They were up sort of 7 to 9% for Black Friday and then the weekend that has just followed. Consumer sentiment, where are you these days on how strong the consumer still is, considering the numbers are good?
So consumer sentiment is all-encompassing. It's about their jobs. It's about their cost of living. It's everything combined. Consumer sentiment surveys have been the weakest they have been in decades. So the average consumer is not doing particularly well. The high-end consumer is doing pretty well, but their sentiment readings are down too. When we get reporting of data, it's in nominal terms. So naturally, year over year, more people are going to go online with their shopping. They don't neutralize for that year over there. So you don't know what the volumes are when you hear about sales numbers
or
being
what the
up.
number, how much they've actually spent.
Again, it's the volume. So you hear a dollar number. So it's going to be up year over year just because of natural growth in that area. And you don't know how much is inflation, right? So I would say the retail net sales numbers have been soft-ish. I would think on a nominal basis, if it was up mid-double digits, that would be pretty impressive year over year, considering those factors. High single digits, I think, is probably on a disappointing side.
So you think does it for you mean a softer holiday shopping season as well? Is that indicative?
Well, it's a softer start, and so what is the reason for it? And there's uncertainty on lots of fronts. But when we hear from the credit card companies, when we look at the default rates, the bottom half is struggling way more proportionally to the top 20, 30% of income earners that are keeping the party going. So the nominal number goes up, but it's fewer and fewer people that are really thriving in the economy as opposed to the average person.
Okay, let's get to whether or not you expect the Federal Reserve to cut for the end of the year. And they're not going to have the most updated information because of the government shutdown. So factor that in as well.
Yeah. So, a week and a half ago, it was off the table. Mm-hmm. You got some Fed talk. We think we know who the next Fed chairman is going to be. I'll talk more about that in the educational part of the show. And so the bias is tilting with the Fed speak we got last week. The Fed meeting is December 10th, 7 calendar days. Blackout is Wednesday. So we'll get a little bit more insight as to what the presidents and governors may be thinking in the next day or two, and then they can't say anything for a week before. Right now, it's about an 85% chance we get a rate cut. So I'd be surprised if it was different than that.
Do you see any information that's forthcoming that might shake that?
Not in terms of real data that's reliable. We have been getting weekly data prints from ADP, which is telling us the labor market on a broad basis, non-governmental, is slowing significantly. From that perspective, is it enough information? It's not the official payroll number, but I think they can count on some of those things if they're looking for a tilt.
Well, that's what I was going to ask you. Would the governors take that information into account? How much weight do they give something like that?
Well, so I don't know, because I don't know any governors firsthand, and you only can go by what they're saying, and they all kind of couch it in that, well, based on what we think we know, this is our bias to move. So I think cutting rates here is not going to matter too much, or if they don't, frankly, and wait another meeting to get some more real data, government-driven data.
Okay. All right, let's take a quick break. We will line up the first phone calls and emails for Larry Berman. We'll put up the information right now. Here is how to reach us, 1-855-326-6266. And you can email your questions, Berman's Call at bnnbloomberg.ca. We're back in just a moment. Welcome back, and thanks for joining us today. We're going to start with an email from Scott. He has a question today for Larry Berman. He says, good afternoon. I'm currently gradually taking profits on some riskier growth-oriented investments, moving to a more income-focused and defensive stance. I'd like to know if Larry would pick ZPay or ZWU or a combination of both going forward. Can you first give us the difference between ZPay and ZWU?
So ZPay is all U.S. exposure. This uses optionality to generate significant income, and there's a lot less overall risk to the market. However, it's all equity risk, and it's U.S. large cap stocks. So if you're taking money out of profits, you're getting back into the same thing with a better yield and a better risk reward profile with ZPay. ZWU is utilities in Canada mostly, 30% U.S., 70% Canada, pipelines and telcos. Very different investments, a lot less market sensitive on the ZWU.
So more defensive?
More defensive in theory, unless oil prices collapse and pipelines go down, the telcos go down further, utility interest rates shoot up and utilities go down. So I don't think any of those things are going to happen. So I would say ZWU is a bit more defensive way to play it if you're looking to make that shift to play defense.
The question was also combination of both, or would you just go one way?
Based on the nature of the question, I would say one or the other is what they're looking for. You don't need to do both. But if you did the ZPay again, you're replacing the same exposure that you've probably
already
taken off the table.
Got it. All right. Let's go to our first phone call then. Chris is on the line. He's in Delta, BC. Hi, Chris.
Oh, hello, Morella. Hello, Larry. Thank you for taking my call. Larry, always appreciate your weekly updates on your YouTube channel. Larry, I'm a 29-year-old investor, hopefully, knock on wood, long time horizon ahead of me. My strategy, I've been investing for 5 years. I'm a leveraged Canadian dividend eligible tax credit interest deductibility type approach. But I'm wondering if I could just take a step back and ask you, if you were in my shoes for a long-term, not timing the market investment, where would you be looking for today? Thank you so much. I'll hang up and listen.
Okay, good question.
No, so that's a great question. And I get a version of this question just about every week in either in an email or online or direct on air like this one. And the answer is difficult because it speaks to how diversified you want to be, how concentrated you want to be. Are you looking for a specific sector? So if you're talking about what would I buy and hold today and not worry about it for 5 or 10 years? There's not an awful lot right now.
Because things have changed very dramatically this year.
That is cheap.
Yeah.
Where I would say good average return. When the multiples are this high, your forward-based return is going to be way lower than average. Problem is, valuations are a terrible timing technique. You can't use that to time markets because, as the saying goes, markets can stay irrational far longer than you can remain solvent or happy in that underperformance position. So it's a challenging question. One that I answered recently with, depending on how speculative you want to be. Now, this is not a dividend play, but the medical marijuana stocks are dirt cheap right now, and I believe we are going to get a change to banking reform. Now, every week or every other week that goes by, there's a headline that changes that perception, but I think it ultimately is coming. And those stocks, MSOS would be an ETF that trades in New York that I would use to trade that, is very, very interesting to me, and it's compellingly priced, where 3 to 5 years from now, I'm pretty sure you're going to make some money there because of that change in U.S. banking laws that would permit more commerce for medical marijuana use in the U.S.
Okay. That is good for Chris. Let's move on to our next caller, Joe from Montreal. Hi, Joe.
Hi, thanks. Larry, I want to ask about ZWK, the BMO U.S. Bank ETF. It's still off its 5-year highs, and I was going to ask you, I was thinking of maybe switching that over to the European banks, but I just don't know that much about the European banks. Would you consider them more fully valued than the Canadian or the U.S. banks? And should I think about maybe switching it over to the European? Would you suggest I stay with the U.S. with the ZWK? I'm retired and would appreciate your advice. Thank you.
Yeah.
Okay, thank you.
A couple of things to unpack there. I think European banks are generally cheaper than the U.S. banks. but not as they once were a number of years ago when we were worried about systemic risk in Europe. Having said that, another component to consider is currency. So as a Canadian, you're taking currency risk with the ZWK against the US dollar. So the Canadian dollar right now, there's not a lot of purchasing power buying that foreign currency. So if you want that US exposure now, I would do it looking out 5 years or so with a currency hedge on, because at some point the Canadian dollar will appreciate. That's probably similar, although not exact, to Europe. So if you can find the right investment vehicle, hedged exposure to European banks, I'm not sure there is one, but European dividend payers with a hedged exposure, there is some, there are ETFs that do that in the BMO world.
Okay. Joe, I hope that works for you. Let's move on to Andres from Calgary. What's your question today?
Hello, Larry, and hello to you too, Morella. I hope you're both doing well. Larry, I have a question about the iron ore steel industry with Cleveland Cliffs as an example. I'm asking about the company, how you feel about them. And, you know, there's Stelco here in Canada and a whole range of other issues with the economy and everything. Or do you think that the shareholders are going to, maybe the companies will do well and the shareholders will get taken, as in the case of Stelco many, many years ago? May I have your thoughts on that? I'm going to hang up and listen to what you have to say. Thank you very much.
Okay, so Cleveland Cliffs, the metals company.
Yeah, so like many commodity-related industries, they're very, very cyclical. These aren't things you can buy and hold for 10 years or shouldn't be. Steel's a little bit different than something like crude oil, but as the business cycle expands and contracts, when there's demand and growth of infrastructure, a steel company's going to tend to do very, very well. And when there isn't, it's going to do very, very poorly. And it could be measured in years in both cases. So if we can look at a Cleveland Cliffs chart for longer term, maybe a 10-year, if it's possible that we can get a 10-year chart up, because I like to look at these longer term perspectives when you're talking about, you know, an investment for years to come. So, you know, obviously in hindsight, COVID, you know, good investment time. There was a period of market weakness in 2015 and 2016, good investment time. Obviously not a good investment time. So we're coming off a bottom here. So I like it from that perspective. How much is it going to go? Listen, don't look for it to get too much above that in context of the next 2, 3, 4 years.
You don't think it'll bounce back to the high it had sort of 2022?
Listen, I think that was a supply shock kind of structural thing that we're not likely to see
won't be repeated
again.
Okay.
So in the next couple years, maybe a drift back to the upper end of the trading range, but not more than that. So I would judge my positioning between the relative low where we are now, that high, you know, an average position at best would be my call at the moment.
Okay. I hope that is good for Andres. Let's go to an email from Sam. With Canadian bank earnings coming this week, are you a buyer of the banks? Do you have a favorite way to play them? What's your take on financials lately? Have they been going sideways? Royal Bank did get an upgrade, I think, recently. So what's your take, first of all, on the space, if you don't mind?
Yeah, so they consolidated, but they've had a massive run this year. And so again, if we can look at a 5 or 10-year picture of the banks for longer term perspective, I like looking at the ZEB, the Equal Weight Bank ETF Index ETF.
Okay.
And if you can look at that over a long period of time, you can see that, wow, you know, we've had a really big run here. So, you know, I'm not sure as an entry location, this is great. So what, you know, when I mentioned the broader markets are pretty expensive, your forward-based returns from here, you're going to get the dividend, so that's great. Mm-hmm. But your capital appreciation from here after a significant run like that historically is less than average.
So it depends on what you want.
So you're going to get a less than
this.
average return.
Okay.
The dividend's good.
Okay.
You're going to get a less than average return looking out 3 to 5 years in the Canadian banks at the moment. That's the view. It could keep going higher, right? But that's what I could tell you from looking at the picture and looking at valuation.
There is some safety in that. There's some sort of defensive play in that.
Absolutely.
If you want it.
Absolutely. And if you want the yield, go to ZWU. It's way cheaper. It's got the beaten up telcos. We know a little bit about that here. And it's got some utilities that are more attractively priced at this point, I think, than the banks.
Okay, good to know. Let's move on to another email from John. He says, hi, Larry, what do you think of Salesforce right now? Salesforce had a pretty good report last time around, and people were already doubting whether or not its business model would have sort of any room to grow or be eaten up by AI. Its chart, though, looks like that. What do you think of Salesforce?
Again, 5-year picture if we can get it. Hate the company.
Okay.
We've dealt with them in the past. They're very difficult to deal with. They are very expensive. They were once upon a time everybody's go-to choice for I need a CRM. I need a way to communicate with their clients. And there are more options today than there were before. And I think it's a bit overvalued at this point. So, if it gets back to that range again, I might look at it, but right now I don't like it. And I think we're going to see failed rallies as it consolidates and, rationalizes and justifies and in the next year or two. So I call it an underperformer.
All right. Let's get to another email then from Andrew. Do you have a favorite way to play silver and gold right now after the gold bull run and silver's record highs of last week? And you always say silver follows gold. Is there room for silver to still grow?
I hope so. I was married 35 years ago. I gave all my ushers a 10-ounce bar of silver as a gift. And I like to remind them these days that, I gave you a gift. You gave me a business card holder. I gave you a gift that's now worth way more than it was when I gave it to you.
Sure.
Anyways, I think I like the sector. I think it's going higher. But right now, you got an element of this because it's so frothy. You can get some pretty violent corrections for weeks. It wouldn't surprise me. Let's look at this trend up here. Wouldn't surprise me if we come back to that trend line, but we're still in a long-term bull market, right? So that's coming at some point, and I'm worried about that, and I would buy into that. When a market's making new all-time highs or close to it, from a value perspective, it doesn't suit my style. It's hard for me to come out and say,
Let's
this
buy
is
in
going
right
to
now.
10,000
Yes.
right now, because I have no idea. I think it's going higher, but it's already gone up. But I was telling people that in here, Morella, and it kept going.
Yep.
So
I remember that. I remember those conversations. How high will it go? We don't know.
We don't know. So bullish, how do you get involved conservatively? I wouldn't be betting the farm. I would have maybe an average position or a little less than average position at the moment.
Okay. That is where we leave it for phone calls and emails. But coming up next is Larry's educational segment. We're back in a moment.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call. We are here with Larry Berman, and it's time for his educational segment. Larry, you want to talk about inflation indicators. What have you been watching?
So last week we heard whispers out of the White House that Kevin Hassett may be the next chairman of the Fed. We don't know for sure, and he certainly hasn't been vetted yet. But Scott Bessent, Treasury Secretary, did the vetting process. I think when you look at who Bessent is and you look at Hassett is together, they make an interesting pair. But it looks to me what's coming together is you've got a cooperative chairman of the central bank. You've got a Treasury Secretary who understands how commerce works. And they're going to come together and, say, manipulate the market in what is a midterm election year to keep a strong economy going through the year, through whatever means they can in their various positions, whether that's adjusting the way funding's done for Treasury or, and it being an active participant leader in the next FOMC. So we'll see how that goes. But from a market perspective, what it means to me is, what is the market perception of inflation looking forward? And one of the best indicators out there is one that many Fed chairs have talked about, and it's the five-year inflation swap. So the Federal Reserve economic database called FRED, which is managed by the Federal Reserve Bank of St. Louis. It's on the website. In my blog post today, I have a link to it. You could follow this online. So this is the expectation of what inflation will be over 5 years from now. And they look at market-based pricing to make this calculation. And what you can see here, going back the last 5 years, is that long-term inflation expectations have relatively been contained. We've had periods of concern where we thought it might be breaking out, but then it sort of comes back into the range. Okay, and so right now and recently, it's been trending down, and this is what's been supporting capital markets for the last number of months, is that future inflation expectations contained. So if Hassett becomes head of the Fed, and if the indication is on how they're going to fund the deficits going forward is stimulative for the economy, we have to be then very concerned that inflation expectations longer term, like this indicator, rise and break out of this channel again. Because that, with all the debt out there, would really cost the U.S. government a lot. Scott Bessent has said, let's focus on the 10-year. Let's make sure the cost of capital for the U.S. taxpayer is as low as possible. They cannot afford long-term inflation pressures to get unanchored. If Chairman Powell and the Federal Reserve were listening to President Trump and they were cutting aggressively here when the economy's running hot and doesn't need it, so here's the debate going into the first half of this year. So is the Fed going to cut? Yeah, they're probably going to cut in December. There's probably enough support of it. They're worried about their other mandate being full employment. So right, that's that dual mandate. So inflation and employment. If you could tell me, Morella, how that's going to play out in the next 6 months, I could tell you exactly what policy is going to do and almost exactly what capital markets are going to do, but we don't know. But those are the things that I'm looking at right now. And if the long end of the curve comes unanchored and we're have to worry about that long-term debt funding, then that's bad for all capital markets across the board.
Okay, and so we'll know sort of early next year whether at least that first card gets put down.
But again, viewers at home can watch this indicator, and if it starts to move to the upside, you know, anxiety levels are
Give them the full name of
markets.
the indicator again.
So this is the five-year forward inflation expectations return, or swap contract.
Got it. All right. We have to leave it there. If you'd like to follow Larry online, he's on YouTube, LinkedIn, X. You can always reach him. Thank you for joining us again. And that leaves where we are today for the show. Thanks for joining us. The close is coming up next. Stay tuned.